Welcome to week 8 of Accounting 250. This week we're going to talk about an extension of last week in chapter 14. We have 3 objectives that we need to cover for week 8. Objective 1 is record the early extinguishment of debt and its conversion into equity. Debt paid in installments is systematically retired over the term to maturity, so that at the designated maturity date the outstanding balance is 0. On the other hand, when a mature amount is specified, as in our earlier illustrations in chapter 14, any discount or premium has been systematically reduced to 0 as of the maturity date, and the debt is retired simply by paying the maturity amount. Sometimes, though, companies choose to retire debt before it is scheduled maturity. In that case, a gain or loss may result. A bond can offer a call feature. A call feature accompanies bonds that protect the issuer against declining interest rates. Even when bonds are not called, the issuing company can retire the bonds early by purchasing them on the open market. Regardless of the method, when debt of any type is retired prior to its scheduled maturity date, the transaction is referred to as early extinguishment of debt. Please review illustration 14.7. So in short, early extinguishment of debt is debt that is retired prior to its scheduled maturity date. Objective number 2 is to understand the option to report liability at their face value. Companies aren't required to, but have the option to, value some or all their financial assets and liabilities at fair value. Remember, in Chapter 12, we saw examples of this option applied to financial assets, specifically companies reporting their investments in securities at fair value. Now we see how liability, too, can be reported at fair value. How does a liability fair value change? Remember that there are two sides to every investment. For example, if a company has an investment in General Motors bonds, that investment is an asset to the investor, and the same bonds are liability to General Motors. So, the same market focus that influences the fair value of an investment in debt securities, interest rate, economic conditions, risk, etc., influence the fair value of liabilities. For bank loans or other debts that aren't traded on the market exchange, the mix of factors will differ. But in any case, changes in the current market rate of interest will be a major contributor to changes in the fair market value. A company has the option to value financial assets as a liability at fair value. Option 3 is discuss the primary difference between USA GAAP and IFRS with respect to accounting for bonds and long-term notes. There are major differences in GAAP and IFRS. One difference is that international accounting standards are more restrictive than U.S. standards for determining when firms are allowed to elect fair value option for financial assets and liabilities. Under IFRS number 39, companies can elect the fair value option only in specific circumstances. This week only has 3 main objectives, but the understanding of these 3 objectives is very important. If you have any questions, comments, or concerns, please call me on my cell phone at 801-867-9681 or email me. Hope you guys have a great weekend and a great week. Thanks.